So I just got out of an investment committee, and we talked about three things at a high level: the macro backdrop and how that's positioned; the micro, talk about a couple of stocks that we addressed, in particular Nvidia, and how the path forward could shape out, and how we may want to position differently how we're investing your assets. So on the macro front, elephant in the room has been the Fed, and that's been the case over the last 12, 18 months. The Fed's been hiking rates at the most aggressive pace, I think, in economic history, and that made for a really tumultuous 2022 for stocks. Heading into this year, sentiment was so bad, the markets have rallied tremendously. But the question is, what's the path forward from here? The Fed and Jerome Powell came out and essentially was sort of continued to be data-driven. And when he says data-driven, he means going to continue to watch how the inflation data unfolds and then make his reaction function hyper-dependent on that data. So he's not wed to cutting rates at some point in time or continuing to hike rates. They're essentially going to watch it play by play and make decisions. Based on the market's reaction and the fact that the 10-year Treasury yield has rallied over 75 basis points to above the 4% level, leads us to believe that the Fed's not quite done yet. And we have firmly been in the higher for longer camp for interest rates, meaning interest rates will possibly remain higher than many people expect, and that's probably net bearish for stocks relative to how markets have trended. And the Fed's reaction was sort of corroborated that conviction that we've had as a team. So it wasn't a huge surprise to us. I would say there's definitely been some macro updates that have surprised us. We've been sort of neutral, roughly on the sidelines with respect to China over the last 12, 18 months, but the data has gotten progressively more bearish over the last few months. The housing and construction sectors in particular have not been great. Those are massive components of China's overall economic growth. So if you're not bullish on housing and construction, it's pretty hard to get really constructive on China's economic growth in general and what that could mean for stock markets. So coming out of China, coming out of the Fed and Jerome Powell's meeting in Jackson Hole, sort of came away still cautiously optimistic, but possibly more cautious than many other people have been year to date. Which leads us to our next point, which we talked about at the individual stock level, we call the micro level. How does that macro backdrop inform where we're going to place bets? I think it's suffice to say, in the AI world, the artificial intelligence camp, is pretty much been immune from any of those macro headwinds. I don't think Jensen Huang at Nvidia is too concerned about how the Fed interest rate picture may shape out. Because the secular demand for artificial intelligence and compute for these large language models is so strong, it can essentially outweigh any near-term blips in the macro environment. Which leads us to the debate we had today, which is now the right time to buy Nvidia stock, especially before earnings. We came to the conclusion that it was not the right time, at least for us. We think the fundamentals are firing on all cylinders. It's hard to pick a bone at any of the revenue or profit guidance the company's been given. However, there's a saying on Wall Street that a great business does not make a great stock. A stock can only be great if the business itself is not fully valued by the financial markets. And you look at Nvidia's year-to-date run, you look at the revenue and earnings revisions by the street and by the buy side, and we came into this meeting today sort of being cautious that things are priced for perfection with Nvidia. And we came away with that same conclusion. Christopher Seifel, one of our analysts, pitched the name, and he himself would agree, really hard to ascertain what the company needs to deliver on this earnings print and what guidance they need to give for the stock just to stay flat, let alone going up. And so for that reason, we decided to sort of sidestep this Nvidia earnings print. Doesn't mean we're bearish on the company. It just means I think we'll get a better opportunity, another bite at the apple at more attractive levels. The last thing I'll talk about was just how we're positioned going forward. Whenever our committee meets, we like to discuss how do we feel about the portfolios. Are there tweaks we would make? Will we add to specific stocks? Will we trim certain stocks? Overall, we feel pretty great about how we're positioned. I think there's a little bit of cleanup to do coming out of Q2 earnings season. Companies where their valuations were already pretty full, the performance had been great year to date, and maybe their results from Q2 were sort of okay. And then conversely, some companies where they're firing on all cylinders, and we had pretty small positions around the 2-3% level coming into the earnings season. To us, that's probably an indication we're too small there. We should be adding. So I'm sure we'll have more to share in some trade updates soon. But just to summarize, on the macro front, a lot of clouds ahead. We don't think we're out of the woods. That's why we remain about 85 cents on the dollar at risk when you invest in our managed stock strategies. A couple interesting names that we're kicking the tires on, including Nvidia and then finally some cleanup to do in the portfolios. But by and large, feeling really great about how we're positioned.